Labor Day is over. It's officially September, and this is my absolute favorite time of year. The air is a little crisp here in the northern hemisphere. The leaves are starting to slowly turn. I absolutely love it. And with this slow change in seasons, we're also going to have to start looking towards the stock market with a little bit more of a cautious eye than we may have had to over the past couple months. I alluded to this a couple weeks ago in one of the vlogs, and I said, listen, I think as much as stocks could continue to rise here for some time, the reality is that the September-October period does tend to see at least some sort of increased volatility, and the odds of a 5 to 10% correction as far as the S&P 500 is concerned are fairly high when we go into this period, traditionally speaking. I received probably 30-40 emails over the past few weeks of people asking me to give them an update on the S&P 500. Now, of course, this is something I do every single day for Clubhouse members, but I think particularly heading into this, what could be somewhat more of a volatile period of September through October, it's important to have some sort of a game plan. So let me show you guys what I'm seeing here as we head into this period and how you might be able to protect yourself and or profit from this. One of the very important things to understand about the stock market is that in order to understand where we are, we need to understand how we got here. With that in mind, let's look at this chart here of the S&P 500 looking back all the way to the 2009 financial crisis lows. And this is a weekly chart, and you can see that basically what the S&P has done after topping out sort of in the late 2014 period, things started to slow down around this point in time here, late 2014. Really what started to happen is that the S&P really mostly just kind of treaded sideways for the most part. We had a couple of outliers here in the summer of 2015 and of course January, February of this year, early 2016, but for the most part we treaded sideways. So from that perspective, this entire move here, considering that we had a breakout now, could be looked at as a constructive price action, and what we could consider from a wave count perspective as wave 5. And I don't make things too complicated here, but if we take this a little bit of a step further and we make a monthly chart out of this, again, multi-time frame analysis, very, very important, guys. On a monthly closing basis, the S&P 500 actually never broke its 2009 uptrend. So this entire uptrend from the 2009 lows actually never really broke if we look at it through the lens of a monthly chart. Okay, very, very important. If we now zoom in closer onto this chart, you can see that the breakout here in July essentially was simply a continuation of the broader trend. If indeed this period here was to have been a constructive sideways move, which for right now, that's kind of what we have to look at. Now, let me quickly take a sidestep. As much as I think we are in an earnings recession and global economic data continues to slow, the reality is that the markets, or at least equities, continue to have some sort of underlying bid, and you can look at different risk assets as well, from high yield to emerging market bonds and beyond. This bid remains. If we then take this a step further and look at things like the financials, look at technology, look at transportation stocks, things that I've talked about in the vlog as of late, these are all things that are, in my opinion, are constructively positioned to continue grinding higher into the year end. However, in the meantime, there's a real opportunity here that the S&P 500 could correct 5 to 10%. So back to the S&P 500 and get right to the point. Here we are on the daily chart, S&P 500 cash. Okay, we look at this and we see clean breakout here in July, like I just said. So assuming the underlying factors that I just said, with the transportation stocks looking good, financial looking good, tech looking good, despite the fact that I think we have an earnings recession, all that stuff I just said, considering all of that, to me it looks like the most likely path forward will be some sort of ABC correction. And let's keep this very simple, guys. An ABC correction is something where you tend to see an uptrend and it looks something like this. Okay, these are healthy, normal corrections, I should say. So you'd see something like, let's say the S&P were to rally a little bit more here, and then it gives us some sort of a down leg like this. Okay, then it gives us a smaller rally, ultimately a push lower, even maybe we revisit those late June lows, and then ultimately we start resuming higher into year end. This is what we call an ABC correction. So wave A would be down, wave B is a counter trend move, or actually in the broader trend direction, and then wave C is sort of the final washout until we then finally get a rally, in this case maybe into year end. So I think here the S&P 500, as much as I could see it go towards 2200, 2250, entirely possible in the near term,
I'm looking to lighten up on positions. I'm looking more and more towards looking at some buying some protective puts just in small size right now, just to kind of feel the market out. Ultimately, once we see a strong bearish reversal on a daily and more importantly on a weekly chart, I'd look to increase short positions because I do think ultimately an ABC corrective pattern at some point here through September and October, maybe into early November, is very, very possible. Doesn't mean you have to sell everything and go crazy short, but an ABC correction here into the September October period looks to be quite healthy and quite probable as far as I'm concerned. And ultimately, though, I do think we'll resume higher through the end of 2016 and probably in the first half of 2017. So that's what I'm looking at here. I hope this helps, guys, and I'll see you in the next video.